In this module, we will discuss about the capital market and SEBI. The capital market is a financial market for securing long-term funds and is distinct from money market which transacts in short-term funds. It brings together the institutional arrangements and facilities for borrowing and lending funds for medium term and long term. Capital market offers various investment options to the investors and facilitate channelization of savings pool for optimum distribution of capital and thereby enhancing the capital formation in the country. It is considered as the indicator of the inherent strength of the economy. After studying this module, you shall be able to know about the capital market, learn the various components of capital market, understand the functions of capital market, understand the need for regulation and setting up of SEBI. Let us now understand the components of capital market. The Indian capital market is divided into gilt-edged market and the securities market. The gilt-edged market is a market for government and semi-government securities which are backed by the RBI. The securities which are traded in this market are not volatile in value and are preferred by banks and other institutions. The securities market is further divided into primary capital market and secondary capital market. The primary market, that is the new issues market, is a market where new issue of equity shares, preference shares, debentures and bonds are offered for sale by public limited companies. The secondary market, on the other hand, is the market for existing and already issued securities. The secondary capital market comprises the stock exchange in which securities are traded, bought and sold, and the gilt-edged market in which the government and semi-government securities are traded. Moving on to discuss the constituents of capital market. The supply of funds in the capital market comes largely from institutions like commercial banks and financial institutions, mutual funds, insurance companies, provident fund societies, merchant banking agencies, credit guarantee corporations, etc. Individuals who directly invest on their own in securities are also suppliers of fund to the capital market. Therefore, as is the case with all markets, capital market also comprises buyers who require funds referred to as borrowers and sellers who provide funds referred to as lenders. An ideal capital market would strive to make required funds available for any business at a reasonable rate of return. In addition, there are several intermediaries who operate in the capital market. These participants, such as brokers, merchant bankers, debenture trustees, portfolio managers, bankers to issue, registrar to issues and share transfer agents, etc., play a critical role in the development of capital market by providing a variety of services. The backbone of a capital market is formed by the various securities exchanges that provide a forum for equity market, and debt market transactions. The stock exchange is one of the most important constituents of the capital market. Presently, there are 20 stock exchanges in the country, of which only 8 have been given permanent recognition. Others need to apply every year for recognition. However, the two main stock exchanges in India through which bulk of the trading is carried out are Bombay Stock Exchange (BSE) and National Stock Exchange (NSE). At present, More than 5,500 companies are listed on Bombay Stock Exchange, thus making it world's #1 exchange in terms of listed members. As of March 2015, the total market capitalization of companies listed on BSE was US $1.68 trillion. BSE's benchmark index Sensex is the country's most tracked index and is traded internationally on the Eurex as well as leading exchanges of the BRICS nation. The National Stock Exchange was established in 1992 and its network stretches to more than 1,500 locations in the country. As of March 2015, 1,733 companies are listed on NSE with a total market capitalization of 99,30,122 crore rupees. Let us discuss the instruments of capital market. Following are the major instruments through which money can be raised from capital markets. Equity shares and preference shares. Equity share. They represent ownership securities of a company and have a claim on the company's asset and earnings. Equity shareholders have a right to vote in the shareholders meeting and receive dividends. The equity shares are easily transferable and highly liquid investment. Preference shares. Preference shares generally do not have voting rights but have a preferential right to receive dividend at a fixed rate before the payment of dividend to the equity shareholders. They also have a right to repayment of capital at the time of winding up of the company before any capital is paid to the equity shareholders. Next, debentures, bonds. These represent the creditorship securities of the company. These are an important source of funds to the corporate sector. These are fixed income securities. The holder of these instruments get a fixed periodic payment in the form of interest during the tenure of the bond and repayment of the principal amount on maturity. Next, American Depository Receipt ADRs. These are dollar-denominated negotiable receipts representing shares of non-US company held by US custodian bank that gives US investors right over a foreign share. ADR is a convenient and attractive investment option to US investors willing to invest and trade in overseas securities. These securities are listed on US stock exchanges and traded like any other listed share. Next, Global Depository Receipts GDRs. A GDR is similar to an ADR as described above, but is listed and traded outside US and outside the issuer's company. Most GDRs are generally denominated in US dollars or euros and are listed on international stock exchanges such as London or Luxembourg. Next, derivatives. A derivative is a financial instrument the value of which depends upon the underlying asset. The underlying asset can be stock indices, interest rate, share prices, foreign currency, etc. The most important derivatives are futures and option. The Bombay Stock Exchange and the National Stock Exchange offers trading in stock index futures, equity futures, equity options, currency futures and currency options. Next, we shall discuss the functions of capital market. Stock exchanges discharge the following functions that aid in the systematic growth of capital formation. First, nexus between savings and investment. The stock exchanges mobilize and channelize the community savings for investment into the sectors which are preferred on the basis of good return, appreciation of capital, etc. Stock exchanges assist in distribution of the new issues of capital and also offers sale of existing securities in an organized and efficient way. Members of stock exchanges also act as brokers and underwriters. They provide necessary assistance in the flotation of new issues and obtain subscription from investors all over the country. Second, marketplace. The stock market integrates private sector and government sector, domestic funds and external funds, the real and financial sector, and long-term and short-term funds. They provide a platform for the buying and selling of securities, thus facilitating transferability from the initial investor to the never-ending stream of buyers. Centralized clearing house and large number of buyers and sellers enable buying and selling of securities at a competitive price. Third, continuous price formation. Since there are large number of buyers and sellers simultaneously operating in the market, this has continuing impact on the levels of share prices. The continuous price formation enables quick valuation of financial instruments. Security exchanges thus act as a barometer of the state of the health of a nation's economy. The efficient dissemination of information enables the participants to take an informed decision pertaining to any financial investment. Let us discuss the need for regulation and setting up of SEBI. A regulator is necessary when public interest is at stake and an institution is required to create, restore, as the case may be, confidence and protect the investors. If the objective of stock exchanges is to provide risk capital to industry, interest of the investors must be kept uppermost. If the investors' confidence in stock market machinery is weak and most of them have a suspicion that there is always cheated by brokers, it is not possible to develop stock exchanges so that they may meaningfully contribute to long-run resource mobilization for industry. Without mobilization of resources, industrial growth cannot take place, adversely influencing employment generation and well-being of common people. For this purpose, various participants need to be monitored and regulated so as to remove any biases and ensure transparency in the dealings amongst the participants. Procedures followed need to be transparent and vulnerability to insider trading and price rigging need to be minimized. Such a secure environment enables orderly functioning and development of the capital market, a crucial input in economic development. Clearly, stock market cannot be left unregulated. Least it should be manipulated to serve vested interest. The role of regulator arises from the need to ensure governance of stock exchange so that it functions and develops in an orderly fashion in tune with the need of the economy. With a view to regulate the functioning of capital market, the Securities and Exchange Board of India (SEBI) was empowered by through an Act of Parliament in 1992. Since then, SEBI has come up with a number of initiatives meant to regulate and develop Indian securities market on the one hand and to improve its safety and efficiency on the other. Now, we will discuss the functions of SEBI. The principal functions of the Securities and Exchange Board of India are provided in the preamble of SEBI. As provided therein, the functions of SEBI are threefold. First, protection of the interest of investors in securities. Second, promotion of the development of, and third, regulation of the securities market. The functions of SEBI relate to regulation and development of stock exchanges. The primary function of SEBI is to regulate the activities conducted in stock exchanges. It registers and regulates the operation of mutual funds, collective investment schemes as well as venture capital funds. It also functions to keep vested interest in check by working as a watchdog over unethical trade practices and insider trading. This prevents price rigging and facilitates a process of price discovery so that the stock market functions properly. To ensure order, it conducts inspection of market agents and makes inquiry before bringing the offenders to book. Last but not the least, it ensures that substantial acquisition of shares are done in conformity with existing laws and monitors takeover of companies, so essential for proper functioning of market of corporate control. It also has to perform functions delegated to it by the central government under provisions of the Securities Contract Regulation Act 1956. A regulatory body like not only regulates the current activities conducted in stock exchanges, it also needs to ensure an orderly evolution of the stock markets. These are termed as developmental functions. In order to help current investors to understand various issues relating function of stock market and to encourage potential investors, it provides education to investors. It also provides training to intermediaries so that they function orderly enough to ensure smooth operation of stock markets. SEBI conducts research on varied aspects and publishes information beneficial for all participants in the market. It also promotes self-regulatory organizations. Let us look at the performance of SEBI since inception. Subramaniathan has made an excellent study of the contribution of SEBI to the functioning of the capital market. For any market to function properly, there are a few preconditions. A clear-cut regulatory setup with unambiguous laws leading to check of non-complaint conduct of market agents and a free flow of information need to exist for a market to function. Without a regulatory push, there would have been underproduction of information leading to exploitation of agents with less information by those with more information. In line with this, Subramaniathan uses the following criteria to judge performance of SEBI since its inception. They include impact of regularity framework and processes put in place by SEBI, flow of information at the behest of SEBI, and detection of non-complaint behavior of participants. Flow of information steps play a crucial role in the orderly at the time of listing, after listing and relating to the trade. He argues that SEBI has brought securities trading under its strict regulatory control over time and there has evolved an all-encompassing improvement in the institutional framework of securities trading in the country. SEBI has taken steps and reined in non-complaint behavior that could adversely affect the operation of the securities market. Such steps included of registration, licensing, eligibility conditions and incentives. These apart, a number of the significant processes have been regulated to make market agents fall in line so that securities market may function effectively without any gain to unscrupulously. Such processes include such as insider trading, takeover activities, issuance of employee share options, manipulative practices, to name a few. It may be argued that claim that the regulatory framework with SEBI in the center is fairly detailed in its coverage of the securities trade. As a market regulator, it has played a critical role in ensuring growth in activity of certain key categories of players in the market, namely such as FIIs and mutual funds. It should not be forgotten that with the announcement of the regulations governing mutual funds, the mutual industry was plagued by the opportunistic behavior of many early players, mitigating the very existence of the private sector segment of the asset management business. through securing itself a say in the process of writing accounting rules through NACAS. SEBI has ensured that the accounting policies of a listed firm are robust, so that it produces reliable information to market agents. This has gone a long way in aiding the scientific discovery of asset price, leading to minimization of the cost of transaction and the risk of settlement. Various agencies' problems adversely influencing the securities trade have been addressed through the corporatization and demutualization of securities exchanges. In terms of enforcement, the available evidence suggests that SEBI has achieved considerable progress in terms of detecting and punishing instances of non-compliance or infractions. Relatively orderly functioning of the trading and settlement systems without any instances of payment crisis until the mid-90s bears testimony to efforts of SEBI. It is not intended to give SEBI a clean chit for its performance. It needs to be mentioned that both the primary and secondary market have been affected from time to time by various other troubles that assumed the proportion of a scam at time, as in the case of the IPOs of Yes Bank, IDFC and several others. SEBI has awarded penalties too late and too little, as in the case of Bank of Rajasthan, in comparison to the financial scale of the misconduct, have had a poor record in carrying its award through the appellate and the judicial systems. Without a more careful analysis, it is not easy to say whether that is the result of poor legal preparation on the part of SEBI or the leniency of the appellate system towards the trade. SEBI's record in enforcing the canons of corporate governance has not been impressive either. Let us now summarize what we have discussed in this module. The capital market is a financial market for securing long-term funds and is distinct from money market, which transacts in short-term funds. The Indian capital market is divided into gilt-edged market and the securities market. The supply of funds in the capital market comes largely from institutions like commercial banks and financial institutions, mutual funds, insurance companies, provident fund societies, merchant banking agencies, credit guarantee corporations, etc. The major instruments through which money can be raised from capital market are equity shares and preference shares, bond, debentures, American Depository Receipt (ADRs), Global Depository Receipts (GDRs), derivatives. The principal functions of the Securities and Exchange Board of India are provided in the preamble of SEBI. As provided therein, the functions of SEBI are threefold: protection of the interest of investors in securities, promotion of the development and regulation of the securities market.